Our main focus point on InvestTalk today is about how to recession-proof your portfolio. Now, the first thing you have to realize about a potential recession, which is looking more and more likely, is that of the 11 recessions since 1950, 5 of them have seen positive returns for equities. So it doesn't mean that the equity markets have to go to hell in a handbasket. There can be subsectors that do poorly, but some sectors tend to do well also, and asset classes. So let's dig into what are those asset classes that typically do well. Number one, it's gold. Gold's already doing well. There's some tailwinds with central banks globally buying more and more. So gold is clear winner in times like these, and what is likely to be a recession sometime in the next couple of years. Then there's US Treasury bonds. Typically, you want to buy long-term treasuries, but I think the difference in this next recession is going to be you're going to want to keep it short-term. Even though the Fed might lower rates and you might see relatively meager returns on those bonds, longer-term bonds could, at least bond yields, could head higher if it's a more inflationary recession and there's worry about the strength of the balance sheet of the US government. So I would stay medium and short term on those US Treasury bonds. Then there's dividend paying stocks, which is kind of similar to the defensive sector ETFs that you could buy. Typical defensive sectors are utilities, staples, as well as healthcare. Now, in today's environment, it's a bit different. You can have sub parts of different sectors. Think of tech. I think of Apple as kind of a consumer staple because most people want to keep their iPhones no matter what. If their iPhone breaks, then they're still going to buy a new iPhone, right? So you want to look at more of the company and see how cyclical their business is. This happens on the retail side as well. Some retailers are very cyclical, others not very cyclical at all. Then there's high quality bonds. The corporate bond market is actually safer than it has been in a long time, mainly because most of the bad lending happened in the private debt space. So that's really where you want to worry. High quality corporate bonds, I think in the medium and short of duration, are probably a good place to be. Then there's REITs. You want to make sure it's not very cyclical REITs. Think of healthcare REITs, apartment REITs. Those type of REITs tend to do pretty well in a recession. Then obviously cash. Cash can always be a good place to be, but you probably want to just buy short-term treasuries. That's kind of cash or cash equivalent anyway.